Good morning, everyone. So this is our first of the sessions that we will be having on Ind AS for the May 2025 exam. So the first standard that I will be covering with you is Ind AS 2, a fairly simple standard, something that all of us are aware of, something that is largely in sync or in line with what we have already studied under Accounting Standard 2 of the previous regime. So with this background, we shall just start this Ind AS on inventories. So what all does this standard intend to cover? So this standard is basically, I will be running through the module for this standard because the module has made the things pretty simple and very much clear. So we will be running through the module and I will of course take you through some of the handwritten notes and points which you can definitely make note for yourself. Okay. So with that, let us begin with the objective of Ind AS 2. So what is the objective of this standard? Why did we need a standard on inventories? So it has two objectives. The first one is determining the cost of inventories, and the second one is subsequent recognition as an expense in the statement of profit and loss. So it comes with a dual objective. Now, why do we have a separate standard on inventories? See, in the manufacturing sector, inventories constitutes a very significant portion of your financial statements. After the property, plant and equipment appearing in the balance sheet, typically the next major item will be your inventories itself. As far as the statement of profit or loss is concerned, your inventory cost or cost of goods sold that we see in the statement of profit and loss is the single most major item of expense sitting in the statement of profit and loss. That is why this standard acquires enormous amount of significance. Though the standard has kept things pretty simple, it's worth to note that some points are equally technical and some points we need to discuss a lot on that. Okay. So with that background, let us commence the discussion. So the objective of this standard, I told you, it is having a dual standard. It is having a dual objective. So it is to prescribe the accounting treatment for inventories. It provides guidance for determining the cost of inventories and for subsequent recognition as an expense. So that is exactly what I have mentioned here. So why do I need to determine the cost of inventories? Because that will go in the balance sheet and subsequent recognition would go in the P&L as your cost of goods sold. There are some scope exclusions to this standard. So when I talk about scope exclusions, I have categorized them into two broad frames. The first one is complete exclusions. That means these two items cannot be regarded as inventories in the first place. Partial exclusions means they are inventories for the purposes of presentation and disclosure. So in your balance sheet, they will come under the category of inventories, but measurement is not governed by Ind AS 2. All of us are aware, how do I measure the inventories? This is something you have been doing from your intermediate levels. Inventory is at cost or NRV, whichever is lower. So, so with that thing in mind, let us look at what are my exclusions. So complete exclusions, you have your financial instruments. So let us assume you are a broker, you deal in stocks, bonds, mutual funds, etc. on a regular basis with your clients. Okay. So when I look at the definition of inventories, these are items which are sold in the normal course of business. So for a broker, the normal course of his business would mean the sale of financial assets. Now, it may appear that it would be his inventory, but because of the scope exclusion, financial instruments specifically covers all aspects of financial assets, all aspects of instruments like equities, mutual funds, everything, whether it is held to sell, or whether it is, held till maturity, whatever be the business model that you are following, which is prescribed under Ind AS 109, whether it is held till maturity, or whether it is held for sale, or whether it is a combination of both of them, all these scenarios are beautifully covered under Ind AS 109, and the presentation matters as well covered under Ind AS 32, Ind AS 107. So therefore, these category of items are completely excluded from Ind AS 2. Coming to the next one, that is biological assets. That is biological assets. Have you studied Ind AS 41? Yes. Have you studied Ind AS 41? Yes. Anyone? Abrakesh, have you studied Ind AS 41? Karthik, good morning. Yes. Mamta, good morning. Hemant, Usha, Sumit.
Not yet, sir.
Okay, not yet. All right. So we have a very interesting standard which you will be studying surely at some point of time. That is your standard which deals with agriculture. So what is this agriculture? And why did I need a separate standard for the same? So your agriculture standard basically deals with measurement of agricultural related items like livestock, like agricultural produce. So that is what is covered under your agriculture standard Ind AS 41. Now, under the agriculture standard, there is something known as a biological asset. So what is a biological asset? A biological asset typically would mean any living animal or plant. Now, if I look at a biological asset like a tree, for example, a tree fulfills the definition of a biological asset. Cattle fulfills the definition of a biological asset. All of them fulfill definitions of biological assets. Sheep. Okay, so all these categories, they become your biological assets. Now, for an entity which is dealing in agriculture, obviously, it may probably trade in cattle. So cattle will become an item of inventory probably. That is covered under agriculture standard. I'm not going into those details right now. Okay, I'm giving a very, very rudimentary picture. Okay, it may be treated as, it may appear that they sell and buy cattle. It may appear that I use the cattle for milk, processing cheese. So that would be my output. So I use my biological assets to harvest output. And that output which is harvested, I further process it to make it something that is my produce through which I can gain income. So that is your overall intent of having a biological asset. So these biological assets, they are specifically covered under Ind AS 41. They will not come under inventory standard. Now, why has this exclusion been made? Why is it not covered under the inventory standard? Very simple, because it becomes difficult to do the valuation of these specific items Let me give you an example. Suppose you have a cattle, you rear cattle, you have your dairy cattle farm. So you rear cattle and you deal with those cattle buying and selling. Now, when you are rearing cattle, obviously you will breed the cattle. So a cattle may give birth to a calf. Now the question is, how am I going to value that calf which is newly born in the financial statements? See, ideally, you would be measuring your inventory at cost. And cost would mean all purchase prices plus taxes, etc., etc. We are going to see that in the coming session. But what about a calf? How are you going to attribute the cost to the newly born calf? You cannot. Under conventional principles, we cannot attribute it. And therefore, a new standard was required to be bought to do the valuation of such specific assets, of such specific items. And that is why the biological assets are carved out and separately covered under Ind AS 41. Have you studied Ind AS 16, property, plant and equipment? Yes?
Yes,
Okay.
completed.
All right. So when you have studied Ind AS 16, you would have studied something known as bearer plants. Do you recollect something known as bearer plants? So under biological assets, you have a category called bearer plants. Bearer plants are plants which bear fruits. You are cultivating them for the purposes of harvesting fruit, harvesting produce and selling it in the market. And these plants will have its own useful life. So under biological assets, bearer plants get covered under Ind AS 16. A bearer plant is a biological asset. But the bearer plant is not covered under Ind AS 41. It is covered separately under Ind AS 16. But that is for a later discussion, or that is something which you would already have covered. The most important point is biological assets related to agricultural activity is excluded from the scope of Ind AS 2 entirely. And the other exclusion in the same category is agricultural produce at the point of harvest. These words are crucial. At the point of harvest. What do you mean agricultural produce at the point of harvest? They are not yet harvested. If you have a fruit tree, for example, the fruits are not yet plucked. They are still lying on, they are still hanging from the trees. So this is your product. You have not yet harvested it. If it is rice, you have not yet carried out the harvesting activity. It is still forming part of the paddy that you have already grown. So this rice grains or wheat or fruits, these items, as long as they are attached to the biological asset, you have not yet plucked them. See, ideally, you will pluck them and then sell it. But until they are plucked, they continue to remain outside the scope of Ind AS 2. They continue to remain outside the scope of Ind AS 2. But the moment they are plucked, we will come to the next point. Sir, what will happen after they are plucked? Suppose you have an orchard of grapes or rubber trees or wheat. The moment I pluck the wheat, it will become quintals of wheat. So that time you will be selling it. That time you are going to sell it. So the moment I sell at that point of time, sir, then to inventory hona chahiye. So that is why there is a very fine difference between agricultural produce when it is covered under inventory standard and when it is not covered under inventory standard. As long as it is on the plant, unplucked, it remains excluded from Ind AS 2. Now let us look at the partial exclusions and you will understand better this example. So partial exclusions means these items are inventories. They will be disclosed under inventories. But when I talk about disclosure under inventories, it will only mean presentation and disclosure, but measurement is governed under other standards. And in this category, we have two types. First one is inventories held by producers of agricultural and forest products after harvest. Are you able to appreciate now? At the point of harvest is not inventory. Uska measurement, presentation, disclosure, everything is out of Ind AS 2. But the moment I pluck the wheat, the moment I have wheat grains and I have filled my sacks with them, the moment I pluck the fruits from the orchard which I have grown, after plucking those fruits, I am going to sell them. So now it will move from a biological asset and become your inventory. It will move from a biological asset and become your inventory. But measurement principles don't apply. Are you able to follow? Measurement principles will not apply. Very simple case. You tell me Suppose you have an apple orchard somewhere in Kashmir or Shimla, right? Shimla is famous for apples. Kashmir is famous for apples. You have an apple orchard. Okay, I'm giving you a very rudimentary example. Now, each apple that you grow and you pluck, how are you going to assign the cost for that? How are you going to assign the cost? See, inventory is purchase price plus conversion costs, etc., etc., duties, taxes, which are non-creditable, etc., etc. How are you going to attribute the cost for that apple? Mangoes. Mangoes, one season they give fruit, other season they may not give fruit. How are you going to attribute the cost to a single mango? You cannot say the watering cost, the development cost, the cost of taking care of the orchard. I can attribute it to all the fruits which I have produced and I will divide by that. How are you going to do that? You don't know how many fruit trees, how many trees will bear fruit. You don't know how many fruits each tree will bear. None of it is standardized. It's all a work of nature, right? And therefore, we cannot apply the conventional principles of cost measurement. And that is why the measurement is scoped out of Ind AS 2. But which inventories, which agricultural produce, which is after harvest. After harvest, it will sit under inventory in the balance sheet, but the measurement principles is governed by that respective standard. Are we okay with this? Yes. And then you have two small exclusions just for theoretical purposes. Minerals and mineral products, which are covered, which are measured at NRV. And the next one is commodity broker traders who measure inventories at FVL CTS, fair value less cost to sell. So who are commodity broker traders? They just buy and sell the goods on behalf. They make a small margin. So they are your commodity broker traders. For a very short while, they will have the inventory, but overall, they are not measuring it at cost because their intention is to immediately sell it off. They are not engaged in, manufacturing, keeping it, etc., etc. So traders, they measure these inventories at fair value less cost to sell. So these are the two categories of exclusions. First one, complete exclusions, two types, financial instruments and biological assets and agricultural produce at the point of harvest. Partial exclusions, presentation disclosures under Ind AS 2, measurement under the respective standards. So these include inventory held by inventories held after harvest, minerals, etc., which are measured at NRV, and commodity broker traders who measure inventories at FVL CTS. Are we okay with this so far? Yes, are we okay? Anybody has any doubts? Yes, just Sumit has confirmed. Just a minute. No doubt. Okay, what about the others? Who all are there? Karthik, Jeannie, Oja, yes, all clear. Okay. Vignesh also has confirmed. Okay, 1 second. Let me just check on the portal whether there is anything that has come up. Okay. All right, fine. Okay, no questions there. Okay, all right, fine. So with that, let us proceed further. All clear. Hemant, Mamta, thank you everyone. Okay, thanks. Okay, all right. Niranjan, uh, Sumit, Hemant, Anila, Vignesh has confirmed. Nisha, I hope it's all clear. Okay, fine. Okay. So now coming to the scope we have discussed already. The same things are mentioned. I have just summarized it. So financial instruments, biological assets at the point of harvest, these are excluded. This standard does not apply to measurement of inventories. So this is your partial exclusions. This is applicable to all inventories except. So this is total exclusions. Okay. So this is what we have all discussed. Okay. Now coming to the definitions finally. So, sir, what is inventory? This is something all of us are well aware of. Sir, what is inventory? Well, inventory are assets held for sale in the ordinary course of business. So that would mean your finished goods in the process of production for such sale, work in progress, in the form of materials or supplies to be consumed in the production process or in the rendering of services. So that would be your raw materials. Okay. So that would be your items. So let us look at it. I have just made a small pictorial presentation. So raw materials covered under inventory. Work in progress will be your inventory. Finished goods in the case of manufactured entity also is inventory. Finished goods for traded items also is inventory. Stores and spares will specifically come. These are interpretations. Useful life less than 12 months, we will treat them as inventories. Useful life greater than or equal to 12 months, it will be regarded as property, plant and equipment. Packing material, will it be inventory? Interesting. So when I talk about packing material, it gets classified under two types. One is your primary packing material and the other is your secondary packing material. So what is your primary packing material? Bottles for beverages, cardboard boxes, tapes, etc. Okay. Basically, your items which bring your inventory to a saleable condition. Let us assume you are Varun Beverages, which is engaged in the supply of carbonated water, Pepsi, Mirinda, etc. Now, its whole saleable product, is it the carbonated water or is it the bottle? So you will tell, sir, it's that carbonated water which they are selling. So can it just install these? Can it just sell the water? Can it just sell the drink? Or should it have to be packaged in a bottle and sold? No, sir, it has to be sold in a bottle. I say he liquid cannot be sold. Yes. So now you think and tell me the bottles, which is basically the primary packing material, should it be categorized as inventory or will it not be inventory? What do you guys think? Karthik,
Inventory.
Niranjan? It will be inventory. Absolutely right. It has to be inventory. Without those costs, without that packing material, you cannot sell your product. It is essential to bring it into a saleable condition. Similarly, your wooden packaging boxes, certain items of machinery, for example, they come in big boxes. Until I put it in those wooden boxes, my inventory cannot even be delivered for sale. I cannot bring it just like that. I have to put it in some packaging. So those packaging items are referred to as primary packing material. As primary packing material, they will be covered under Ind AS 2. Secondary packing material. Now these are publicity materials, advertising. All these become your secondary packing material. They are not having any contribution towards bringing your inventory to a saleable condition. They are only having your contribution towards publicity, for example, and therefore they will not be covered under inventory. उनका आपके inventory के साथ कुछ लेना देना नहीं है. Okay, so this is broadly your inventory items. Okay, so let us come back. So they have explained the same thing further. Goods purchased and held for resale. So this would be your traded items. Yes. Even land held for resale in the case of a real estate developer. Yeah, Brakesh, tell me.
Sir, what about inventory of posters and POS materials? Like general FMCG have a huge stock of them. So are they
Uh,
inventory? Because
Inventory of what did you say?
posters and POS material like Coca-Cola, and they used to distribute that glass, cups, balls like that. Are
Okay.
they part of inventory or is other than inventory?
So now you will have to look at it that whether it is essential to bring the inventories to a saleable condition. What is Coca-Cola or what are these entities doing? So for example, if I talk about FMCG, let us take an entity like Hindustan Unilever Limited, HUL. Now, HUL's products includes shampoos, soaps, toothpastes, I mean, detergents, everything. So now for these entities, you will not go to a shop and find something like if you want a detergent, they will not give you the powder loose. It will be packed in some material and given. So that packing is going to be your primary packing material. It will be your inventory. But posters or publicity, what you are talking about, cups, this is not going to be your saleable items. Okay, these are not essential to bring your inventory to a saleable condition. Coca-Cola, for example, will have its own cups, which it puts into your outlets, for example. They cannot be your inventory per se because they are not bringing your inventory to a saleable condition. They are just they are just branding those cups so that tomorrow anybody deals in those cups, anybody deals in that beverage and puts it in that cup, then it is the advertising that you are going to achieve. So, for example, Coca-Cola gives the beverage. Let us take an outlet like Domino's, for example, or Pizza Hut or McDonald's. So, the beverage company will typically deliver the beverage in the containers which are stored in these locations. And they will also probably deliver the cups which are having the branding of the company to which that drink pertains. Now, these cups are not essentially bringing the beverage in a saleable condition because the beverage is already sold in the container which is available with that particular retail entity. So those cups are essentially your advertising material for Coke or Pepsi or whatever it is. So in my opinion, they will just be a publicity item. You will buy and sell or you will manufacture and sell. Typically, these go out as job work contracts. Okay, somebody will manufacture, deliver it direct to the outlets and take care of it. Or they may even tell to these entities, you only store, you only have to put a rebranding. For that, we will, partially subsidize the beverage that we are selling to you. But that is the way the things probably get treated. Is it okay, Abrikesh? Yes. Okay. Anybody, any doubts?
Sir, what about Amazon packing materials? Sir, once it is packed, again they will have their own packing, right? Maybe the box or the Amazon cover.
So again, now when we talk about Amazon packaging material, see, typically your Amazon is an entity that deals in distribution, right? So for Amazon, that cardboard box, what you are talking about, is essential to bring the inventory to a saleable condition because it is on that box where you stick the customer's name, you preserve the identity. See, tomorrow a delivery boy will deliver, let us say, an iPhone, or to somebody he may deliver some Android phone or something else. So we are protecting the inventory's identity so that the end customer only should have the information of the contents which it is getting delivered. So in the case of an entity like Amazon or Flipkart, the packaging material serves a more deeper purpose than what would the cup serve for an FMCG. And therefore, these items, in the case of Flipkart and Amazon, they would definitely be categorized as your inventory of packing materials. Is it okay? Yes?
Yes, sir.
Okay, so it all depends on a case-to-case basis. What you have to identify is how integral this particular material is towards bringing my goods to a saleable condition. If it is integral, go ahead, it becomes your inventory. If it is not integral, then at that point of time, it will be just an expense that will be debited to the profit and loss. Okay, all right. So finished goods, so this is work in progress, or materials and supplies awaiting use, raw materials. Okay, all right. You can understand this when you study Ind AS 115. Costs incurred to fulfill a contract with a customer that do not give rise to inventories are accounted as per Ind AS 115. So what is this? We will look when we study Ind AS 115. Okay. Now, okay, so this is the same thing what we discussed, whether packing material and publicity material are covered by materials and supplies awaiting use. Packing material is inventory, agreed. Publicity material is not inventory. So that is the solution which is given. Okay. So this is done. Illustration 1. Okay. Now coming to the next part. Okay. Okay, I hope till now it's all clear. Yes, I hope it's all clear till now. Anybody has any doubts? Yes, Karthik has confirmed. Abrikesh, all clear? Okay, I hope it's clear. Abrikesh, I hope you got the answer to your query. Okay, all right.
Sir,
What is, yes,
gift item is not inventory. Then under which category it will fall?
which one, madam?
Mamta, sir.
Yes, ma'am, tell me. Yeah, I
Gift
didn't get
item-
your question.
Gift items that we got with any product
Okay,
that is not inventory. Then under which category it will fall?
when you are saying gift items, do you mean inventories like 1+1 sale or those types?
No, sir. Like shampoo with any product, bag with
अच्छा,
shoe.
आप कह रहे हैं that फॉर एग्जाम्पल मैंने एक प्रोडक्ट खरीदा, उसके साथ एक और प्रोडक्ट आ गया, राइट? आप वैसे कह रहे हैं ना, यू गेट समथिंग फ्री.
Yes, sir.
हाँ, तो उस केस में दैट इज ऑल्सो एन इन्वेंट्री, बिकॉज यू आर नॉट मेकिंग दैट. नाउ दिस बिकम्स अ सेल प्रमोशन एक्टिविटी, ठीक है? बट दैट सेकेंड प्रोडक्ट विच इज कमिंग फ्री, that second product which is attached to the first product which is coming free, that becomes inventory because that is in a saleable condition at zero value. Are you able to follow? When you study Ind AS 115, then at that point of time you will understand that when entities give these offers like 1+1 free, or you sell something and you get a detergent free. So all these typically would come under composite sale. So when these come under composite sale, you have to determine the standalone prices of these items and then allocate the selling price to each of them separately. Because ideally, nobody gives items free. So there will be a selling cost, a sale value that will be attributed to the free item, and uska cost to aapke paas hoga. You will be having the cost of that item. So it will be your inventory. This is just a marketing strategy. The first basic thing that we have to understand is under Ind AS, nothing is free. When you are studying financial instruments, you will study डीप डिस्काउंट बॉन्ड्स और जीरो कूपन बॉन्ड्स. जीरो कूपन बॉन्ड्स क्या होते हैं? दे डोंट गिव यू एनी इंटरेस्ट एट द बिगिनिंग or over the life of the bond, but they give you a very high redemption value. Now, why do they give a very high redemption value? Because they have not given you any interest. So when I have to do the accounting for a zero coupon bond, I cannot do the accounting as I issue the bond at 30 rupees. and I redeem at 100. So 70 rupees will not be my loss on redemption. This would happen under accounting standard 13. But when I talk about my financial instruments, 70 is the financing cost, which I will amortize over the tenure of the bond. Similarly, when we study accounting standard 20 on government grants, when you get an interest-free loan, that interest-free loan is not interest-free. There is a particular component which we have to identify and record that component in the financial statements. Okay. When I talk about non-convert or when I talk about convertible debentures, there will be an equity component. Okay. There will be, because it is debenture plus an equity option. Similarly, when you are talking about product plus something free along with it, the something free is actually not free. It is part of the transaction price that you have paid for buying that product. आपको as a consumer आपको लगता है आपको free में मिला, which is fair enough. But the company's perspective, it's not free. There is a selling price that is attributed to that. And उसका cost भी होगा. So you have made it a saleable item. It will be regarded as a sale, and that free item, I do it in quotes because it is free in a layman's terms. Under the perspective of financial reporting, it is not free. Many times what happens, you will have certain offers, like you, for example, you buy an air conditioner. So air conditioner will come, say, air conditioner cost plus 5 years warranty. Now, when you free, they will say, we are giving 5-year warranty free with the air conditioner. Now, is it really free? You have to ask yourself that question. वो free नहीं है. That 5-year warranty का जो cost है, it is inbuilt in the selling price of the air conditioner. Under accounting standard 9, revenue recognition, what you would have done is, you would attribute entire sale value to the air conditioner, and you would make a provision for the warranty cost over 5 years. ये आप करते थे. But under Ind AS 115, what are you going to do? You will find the standalone price of that warranty service. You will find the standalone price of the air conditioner alone without warranty. And then you will attribute the transaction price to each of them. The moment you deliver the air conditioner, you will recognize the revenue pertaining to AC sale. But the warranties are not provided today. It is provided over a 5-year tenure, and therefore the revenue attributable to the warranty service will be allocated or will be spread over the 5-year tenure. Similarly, free के case में, so free items will continue to remain your inventories. Are we okay with this, Mamta? Yes.
Sir, very much clear, sir.
Very much clear. Okay, fine. Okay. So yeah, that's right. Included in the transaction price. Perfect. All right. Great. So ठीक So see, there are certain terms which we will be covering as a part of our discussion. Okay. Net realizable value and fair value. So first thing is measurement of inventories. This everybody knows. It is at the lower of cost or net realizable value. Everybody knows, even if I wake you up in your sleep, you will tell me, sir, valuation, cost or NRV, whichever is less. Usme koi doubt nahi hai. Okay. So there, everybody is clear. I'll not spend much time. But coming to cost, what is cost? So in this case, cost of inventories will be your purchase cost. Purchase, what all are you going to purchase? You will either purchase traded goods. If you are trading, then the traded FG will be your purchase cost, or it will be your raw material if you are manufacturing. So your purchase price plus conversion costs. If you are a manufacturing entity, you will have your labor costs. You will have your direct expenses. You will have your direct overheads. You will have your overheads, production related overheads. All of them put together will form part of your conversion costs. And other costs necessary to bring inventories to present location and condition. Okay. the freight, vagera, all those items will be your other costs necessary to bring inventory to present location and condition. Now, we will look at these items in detail. So when I talk about purchase cost, what is included in this? It will be the basic purchase price. That is your invoice price. So when I talk about your invoice price, this will be the taxable value. This will be the taxable value. Taxable value, the basic price. If it is an imported item, then it will be the invoice price itself, because in respect of import and export, taxes will typically not come into the picture. So purchase price plus import duties and other taxes. So customs duty is not a creditable duty. I hope you are aware of that. Customs duty is not creditable. उसका refund नहीं मिलता है. Okay, on the imports. So customs duty will be part of the cost, and other taxes other than refundable or creditable taxes. On respect of many of your purchases, we are able to avail input tax credit of GST. आपको तो पता ही होगा. Yes. So when you are availing the input tax credit of GST, it will not be your cost, because you have paid for something which you will utilize to set off a liability in the future. तो वो आपका cost नहीं होगा. It will sit in the balance sheet as a current asset. But non-creditable items, you will add it to the cost of the inventory. Okay? So that is your second category. Plus transport and handling costs, freight inward, handling charges, loading, unloading, all of them put together will be your cost, plus any other direct costs related to acquisition of finished goods, raw materials, or services. So all these things put together will become your purchase cost. ठीक है? Trade discounts, if any, will be deducted. That is your rebates. Trade discount क्या होता है? Suppose you place a bulk order, let us say for 1000 units. Let us say you are anticipating a festive season and the purchases will go up, and therefore you place a bulk order for say 10,000 units of the item you are dealing in. इतना ऑर्डर कभी आपने दिया ही नहीं है. So this was a very huge order for the supplier also. So he will say, okay, I will reduce your price overall. So it becomes a trade discount. Trade discount will be deducted. Cash discount is what? This is a discount for prompt payment. Suppose you get a credit of 60 days. Okay. And then you will say, I don't need a 60-day credit because my customer pays me within 20 days as per my terms of arrangement with him. So I will pay you within 30 days. Now you tell me what is the discount, and you make the payment within 30 days. You offer to make the payment on the 30th day. Then the supplier is going to give you a cash discount. Let us say he gives you 0.5% cash discount. Now this 0.5% cash discount, is it related to purchasing or is it related to payment? Is it related to purchasing or is it related to payment? What is it related to?
Cash discount is related to payment.
Cash
encourages
discount.
Immediate payment.
Yes, to encourage immediate payment. So when it is related to payment, it does not have the essence of procurement. It is basically you are reducing somebody's financing cost, or you are incurring that financing cost. आपको 2 महीने का credit था, you made the payment in 1 month. Somebody got a time value of money benefit of 1 month. You have lost a time value of money benefit of 1 month. So this is in no way connected to your what you can say, this is in no way connected to your purchases. So cash discount, I will not deduct it in determining the purchase cost. It will be credited directly to the statement of profit and loss. Are we okay with this? Yes. Okay. So now when I come to my conversion costs, purchase cost we discussed. When I talk about conversion costs, it will be direct labor. In your direct labor, you will have skilled, semi-skilled, unskilled, and all their wages, whether it is salaries, whether it is bonus, whether it is contribution to provident fund, contribution to ESI, contribution to labor welfare fund, overtime pay that you do, all of them put together will become your direct labor cost. These are the shop floor employees. Who are critical for manufacturing the goods. So unka cost bhi yahan par aayega. Yes. And then you will have certain direct costs like royalty paid. Suppose you are buying a material with a brand name. Okay, you are buying a material with a brand name to sell that. So you are profiting, you are able to get more sales because of that particular brand, for which you need to pay a specific royalty. So typically you have these arrangements in the bread industry or bakery industry, where you buy the material, and on that material purchase, you will have a 1% royalty that has to be paid. So some of these royalties could be linked to your sale. Some of these could be linked to your purchase. So when we talk about royalties linked to your purchases, then it is a direct expense. So therefore, that also gets added to your cost. So raw materials plus direct labor plus direct cost, this becomes something known as your prime cost. Have you people studied costing, cost accounting, management accounting? Yes.
Yes, sir.
Okay. So this is essentially the cost sheet format. Raw material consumed plus direct labor plus direct cost gives you something known as prime cost. To the prime cost, you will add your factory overheads. That is overheads related to production. It could be manufacturing overheads. It could be production overheads. So fixed overheads and variable overheads. So it is key to note that direct labor is a per unit cost. Typically, it varies directly with the output. Royalties and all direct cost, they also are perfectly variable. So it comes on a per unit basis. Your variable overheads like electricity, water supply, etc., they are also directly related to your output. So per unit cost mil sakta hai uska. Your fixed overheads are period costs, factory rent, for example. Okay. Indirect labor salaries, for example. These are period costs. They are not related to your production activity directly, but they do have a bearing on the final product. And therefore, our job is to convert this period cost into a per unit cost. When I say period cost, I mean to say that the deciding factor for incurring the expense is the period. Rent. Is rent related to your production? Answer is no. Your landlord will tell whether you want to manufacture or you want to stay idle or you want to sleep or you want to do whatever you want in my premises. It doesn't really affect me. What matters to me is I should get my rent by the first of the next month. If this is okay, I am okay with whatever you do on my property. Of course, he will put basic conditions, damages should not happen, this, that should not happen, etc., etc. But this is the key focal point. That it depends on passage of time rather than the production. So what we have to do is we have to convert this fixed overheads into into per unit costs. We have to convert this into per unit costs. Okay. And that conversion technique is what is known as absorption costing. How many of us have heard absorption costing? Yes, Karthik, Abrakesh, heard?
Yes, sir.
Okay, all of you have heard it, right? Niranjan, Jeannie, Oja, Mamta, Sumit, Usha, Hemant. I hope all of you, Anila, Vignesh. Yep, all right. Okay. So absorption costing is a technique for basically putting my fixed overheads into variable overheads. Okay. So now coming back to the absorption costing, how does it work? In brief, let us understand. We have to calculate something known as absorption rate, which is also known as a recovery rate. How do I calculate that? It is basically overheads divided by level of activity. So when I talk about level of activity, I have 6 types: output method, machine hour method, labor hour method, percentage of labor cost, percentage of material cost, percentage of prime cost. Obviously, these 6 methods are not at all important for you to remember. But just wanted to give you an understanding ki bhai absorption, how does it actually happen? How can it happen? So you have to select what is most suitable to your industry and apply that specific absorption. Okay. And this will be based on normal capacity. This will be based on normal capacity. Okay. So that is all about absorption costing, which you will have to understand, So let us just come quickly to our discussion. So cost of inventories, we have seen purchase, conversion, other costs. Cost of purchase, we have seen purchase, import, other taxes, transport, handling, and directly attributable costs. Okay. So all of that is done. Now let us look at this particular illustration. Small illustrations are there. Nothing difficult or nothing which is unfamiliar. Okay. So ABC buys goods from an overseas supplier. It has recently taken delivery of 1000 units of X. Quoted price was 1200 per unit, but ABC has negotiated a trade discount of 5%. So do I have to deduct this in arriving at the purchase price? Yes.
Yes.
Yes, sir.
So therefore, your purchase cost alone will be 1000 units into 1200 per unit into 95%. So that gives you 11,40,000. The supplier offers an early settlement discount of 2% for payment within 30 days, and ABC Limited intends to achieve this. Does it bother me for calculating the purchase costs related to this inventory?
No.
No, because it is related to settlement, it's not related to purchase. So this part, ignore. That is meant to confuse you. Okay. Import duties or basic customs duties of 60 per unit must be paid before goods are released through customs. Is this required to be included? Answer is
Yes, sir.
yes. These are non-creditable. So 1000 into 60, 60,000. Once the goods are released through customs, ABC must pay a delivery cost of 5,000. So I will include 5,000. So total value of your inventory is 12 lakhs 5,000. Are we okay with this? Yes. Any doubts? No doubts? Very simple. Okay. Cost of conversion, we have seen direct material, direct labor, other direct costs, systematic allocation of fixed and variable production overheads that are incurred in converting materials. So this is your absorption costing. This whole point is related to absorption costing. Pad lena, it is exactly the same what I have discussed. Can I proceed or do you want me to spend time on this? I can look at the question that is there in study material highlighting absorption costing. So can we do that? Yes. Let's take up the question. All right, we can go ahead. Okay, fine. Okay, so let us go ahead because this is what exactly we have discussed. I think doing a question is going to help solve our whatever issues we may be having. clearly. Okay. The following information is gathered from an entity. Full capacity 10,000 labor hours in a year. Normal capacity 7,500 labor hours in a year. Full capacity and normal capacity, what is the difference? Full capacity is if you use your facility for maximum time without any holidays, all the 3 shifts, that is your maximum capacity. Normal capacity is what you intend to achieve. So I intend to achieve 7,500 labor hours capacity. So that is your basis for absorption. Maximum cannot be the basis for your absorption because you will never achieve maximum capacity. Okay. Actual labor cost for current period are 6,500. Total fixed production overhead is 1,500. Total variable production overheads is 2,600. Opening inventory 2,500. Units produced in the year 6,500. Units sold 6,700. Cost of inventory is assigned by using FIFO formula. Determine the cost of inventories. Determine the overhead cost to be allocated to cost of goods sold as well as the closing inventories. Okay. So can we do this question right now? Yeah. We shall try this question. Then we shall come back to the theory because I feel that it's better we do the question before, going further so that you can understand it. Okay. Now, you are having output method because you know the output, it is 6,500 units. You are having actual labor hours 6,500 hours. Now, the question that comes is, I showed you 6 methods. How do I allocate my overheads? Should it be output method? Should it be labor hour method? Should it be machine hour method? Percentage of labor cost, percentage of material cost, percentage of prime cost. So
Labor
always, I didn't get you, madam.
Labor hour method we will use.
Why? Any reason?
Because the units and the given is labor hour.
Units is also there. So can I not use
capacity level is given in labor hours?
Capacity is given in labor hours. Absolutely right. Capacity is given in labor hours. That is the first thing that you have to see. What is the capacity metric which is given to you? It is in labor hours. So your allocation should be based on the labor hour method. Okay. So now let us look at labor hours required. So total units produced 6,500. Actual labor hours 6,500. So therefore, hours taken to produce 1 unit is equal to 1 hour. 6,500 units, 6,500 hours. Now, absorption rate. Absorption rate is equal to, where is it given? Your total fixed production overhead 1,500, normal capacity 7,500. So this is equal to 0.2 per hour. 0.2 per hour. Are we okay with this? Yes. So each hour spent, I will allocate 0.2 rupees of fixed overheads to that. So now total labor hours is equal to 6,500. Yes or no? Yes. Therefore, fixed overheads absorbed 6,500 into 0.2 is equal to rupees 1,300. Are we okay with this? Yes. Any doubts? Abrikesh, Karthik, everyone, no doubt. Yes. What about? No doubt. Okay. Jeannie has confirmed. Mamta, all clear, ma? Yes.
Yes, sir.
Okay. Sumit, Usha, Hemant, Nisha, Anila, Vignesh, all okay? Yep. So let us proceed further. Okay. All right. So you will have under absorption or unallocated overheads. Your fixed overhead 1,500. Absorbed is 1,300. So 200 is going to be your under absorption, 200. Now, what are you going to do with this 200? What are you going to do with this 200?
This will be expensed off.
This will be expensed out. Why? Because you have allocated based on normal capacity. You had expected that I will at least utilize 7,500 labor hours. आपने वो किया नहीं. You have not utilized 7,500 and you have utilized only 6,500. So whose fault is it? Sir, it is my fault as the management that I have underutilized my capacity. तो फिर suffer the consequences. Take this hit to your profit and loss. Take this hit to your profit and loss. So 200 will be expensed to P&L. See, the biggest thing that you have to understand is companies will always prefer to absorb overheads. Reason being, your margins will be correct, number one. Second, inventory costs will be a better representative. And third one is, they will not want to take these surprise hits to the P&L. It will become difficult to explain. So these are the three reasons why they will always prefer to go on a month-on-month basis. इसको आप साल के end में करोगे, then you have no possibility of rectifying it. If you do the absorption activity at the end of the year, then where is the room for rectification? If there is under absorption, there is under absorption. Take the hit to your P&L, go ahead, because you cannot carry forward this. See, absorption costing gives you four methods of treatment of under or over absorption. First method is carry forward, where this 200 under absorption, I will carry forward to the next year. But financial accounts cannot provide carry forward option. क्या करके आप carry forward करोगे? When I say carry forward, what are you going to do? It will be fixed overheads to bank. This will be 7,500, not 7,500, 1,500. You have absorbed inventory to fixed overheads 1,300. So fixed overheads is still left with a debit balance of 200. What are you going to carry it forward? This is not an asset. You are not going to get any benefit out of this. It is not prepaid expense also. If I do the carry forward option, this has to go and sit as an asset, but it does not meet the criteria of asset. So carry forward method cannot be done. So we take the next best method. Take the hit in the profit and loss. Take the hit in the profit and loss. Remaining two methods are there, but they are highly costing oriented. I will not touch those items right now. Okay. There is a supplementary method and there is part P&L, part supplementary. So that is something which is best left to costing. Okay. Yes. Yeah, Pooja, tell me.
Sir, can we say that the fixed overhead is period based? So it has been accrued over the period, and we have also paid during the year, and it relates to our current financial year. That's why we have to show that full 200 in expense of P&L. because it relates
बिल्कुल
to
सही.
cash.
Absolutely right. That is the whole intention. I mean, that is the whole reason why I cannot carry it forward, because आपका cost इस साल का खर्चा है. I'm not paying something for the next year. So costing gives you that option, but financial accounting says you cannot do such kind of activities because खर्चा इस साल का है, इसी साल में book करो. Sir, under absorption, that is your problem. I need 1,500 to hit my P&L. Now, whether you hit it through inventory or whether you hit it in the P&L, it's none of my concern. I am giving you the guidance how it should be done. Okay. But tell me one thing, since I'm just mildly deviating, suppose, now this is something that I will explain why this becomes an issue, but let me just ask you, how many units did I manufacture? 6,500. 6,500 यूनिट मैंने बनाए. I made 6,500 units. Assume I have not sold anything. Assume I have not sold anything. Unsold. Yes. So where will this be stuck? Current year में I produce 6,500 units. मैंने कुछ नहीं बेचा. So how will your P&L look like? It will go and sit as closing stock. It will go and sit as closing stock. Yes. Closing stock of current period will become opening stock of next period. Yes or no? Closing stock of current period will become opening stock of next period. है कि नहीं? So मैंने कितना एब्सॉर्ब किया? सर, आई हैव एब्सॉर्ब्ड ₹1,300. This 1,300, did I expense it out in the current year? Understand my words carefully. Did I expense out 1,300 in the current year? Has it hit the P&L or has it not hit the P&L?
Not hit the P&L yet.
It is not hit the P&L yet. क्यों? If I just do a T-form balance sheet, a T-form profit and loss, sorry, I will have fixed overheads 1,500, and here I will have closing stock X plus 1,300. So P&L में what is getting hit? P&L में it is only 200 which is getting hit. Yes or no? Are we able to follow? X is the inventory cost, purchase price, etc., all of that put together. 1,300 is overhead absorbed. Are we able to understand? Yes? Yes or no? Everyone.
Yes, sir.
So next
Yes.
year, I will put this as year 1. Year 2, my opening stock will be X plus 1,300. Are we okay? Yes?
Yes, sir.
Now, what Pooja spoke just a couple of minutes ago. Yes, sir, we have to expense the entire amount because ये current year का खर्चा है. I said emphatically, yes, वही करना है. But tell me one thing, is this rule being followed here? Is this rule being followed here? Yes. Am I expensing 1,300 in the current year, or is it getting carried forward to the next year?
Carry forward to next year, sir.
It is getting carried forward to the next year. करना यही है अपने को. We have to do this. This is what Ind AS 2 has prescribed. We have to do this. I'm not saying what we are doing is wrong. I'm saying that from a costing perspective, this is not what is the thought process of management. Management wants to see 1,500 hit the P&L. That is why only for this reason, what happens is management accounts or managerial accounts prefer marginal costing over absorption costing. मार्जिनल कॉस्टिंग में क्या होता है, पीरियड कॉस्ट्स आर एक्सपेंस्ड इन द सेम पीरियड. Yes, period costs. Rent है, it has nothing to do with my production. Hit the entire cost in the P&L. Their inventory will be valued at purchase price plus duties and taxes plus variable overheads. Fixed overheads is not going to come there because fixed overheads I have taken the hit entirely in the costing P&L. So that is the reason why you are having this particular gap. Are we okay with this? Yes, this was something I just digressed a little, but for our Ind AS 2, you have to do this. Even though this anomaly exists, आप यही करोगे, you will not do anything beyond this. Are we okay with this? Yes. Everyone? Understood?
Yes.
Yes. Mamta, Abrakesh, yes. All clear? Okay. Pooja समझ में आ गया?
Yes, sir.
Okay. All right. Fine. So better to rub this off because this will create more confusion. Okay. So now let us come back to our question. Okay. So 200, we are expensing it out in the P&L. Now coming to variable overheads. Total variable production overhead is 2,600 and this is variable. So this is directly related to your labor hours. So variable overhead absorption is equal to rupees 2,600 divided by 6,500 labor hours. So this is equal to rupees 0.4 per hour. So for the units manufactured, you will allocate 0.4. You will allocate 0.4 per hour. Are we okay with this? Yes. Now, what is your opening stock? Total units sold is 6,700. Opening is 2,500. And manufactured is 6,500. So your closing inventory equals opening of 2,500, manufactured 6,500, sold is 6,700. So you will be having 2,300 units. You will be having 2,300 units. Are we okay with this? Yes. Are we okay with this? Any doubts? Okay, no
No.
doubts? Okay. So now overheads absorbed in closing inventory. Total, that is fixed plus variable, is equal to 2,300 units into each unit takes 1 hour to manufacture, 1 labor hour, and it will be 0.2 fixed, 0.4 variable. I hope you are able to recollect. 0.2 is this rate, what we have calculated here. 0.4 is this rate. So 2,300 into 0.6, this is rupees 1,380. This is rupees 1,380. This is the overheads which are absorbed. This is the overheads which are absorbed and which will be part of your closing stock. Which will be part of your closing stock. Are we okay with this so far? Yes. Are we okay with this so far? Yes. So this is the total overheads absorbed in the closing inventory. Now, total overheads absorbed in COGS, cost of goods sold, is equal to, now this is overheads absorbed, that is why I am taking 6,500. Otherwise, unit sold is 6,700, which is out of 200 from the opening, right? So 6,500 minus 2,300. 6,500 minus 2,300, you have sold these many units from current production is equal to 4,200 into 0.6, 2,520 plus unabsorbed overheads 200, 2,720. 2,720. Are we able to understand? Yes. Are we able to follow? Yes. Any
Yes.
doubts so far? Yes, बोलिए.
ये यूनिट सोल्ड में से जो 2500 ओपनिंग इन्वेंटरी फर्स्ट लॉट क्लियर हुआ, ये क्यों नहीं किया अज्यूम?
Because that pertains to previous years, उसका डिटेल नहीं है ना अपने पास. See, I'm only looking at overheads absorbed. ओके, ओवरहेड्स एब्सॉर्ब के लिए तो बेटा मेरे पास सिर्फ करेंट ईयर का डेटा है ना. सो व्हाट इज सोल्ड आउट ऑफ ओपनिंग स्टॉक, उसका डेटा तो मेरे पास नहीं है. सो राइट नाउ द क्वेश्चन इज ओनली फोकसिंग ऑन ओवरहेड्स एब्सॉर्ब. दैट इज व्हाई आई एम ओनली लुकिंग एट करेंट ईयर कॉस्ट. आर वी ओके?
यस सर.
Yes. If I was given that data, I could have considered the opening stock inventories also. Okay. All right. What is your total overheads? Fixed was 1,500 and variable was 2,600. Please confirm. 4,100. Yes. Everyone, Abrakesh, all okay? Nisha, Pooja, Mamta, Niranjan, all clear? Yes. Jeannie, this is okay?
Sir, how these 200 have been arrived in last, unabsorbed cost, last para?
Yeah, I'll show you. It is this one. See, I had incurred 1,500. I have absorbed 1,300. So unabsorbed is
Yes.
200 expense to P&L. Correct?
Okay, that's all. Okay.
That's the same thing. Okay.
Okay.
So now, how is this 4,100 appearing in my inventory related items and P&L? So absorbed in COGS, how much it is? 2,520. Absorbed in closing stock, 1,380. So this gives you 3,900 expensed in PL, 200, 4,100. This is under absorption. Are we okay with this? Yes. So this is how this 4,100 has effectively been taken care of under Ind AS 2. All clear, beta, everyone? Yes. Sumit, Usha, Hemant, Jeannie, Karthik, Anila, Vignesh, Nisha, Pooja, all clear?
Yes sir.
ठीक है, shall we proceed further? Yes, आगे बढ़े. Okay, so let us process this further. All right, now let us look at a little bit of our theory, what we have. Okay, so once we look at that theory, then it will. So fixed overheads, I have told you, remain relatively constant regardless of production volume. such as depreciation, maintenance of factory building, equipment, etc., etc. Allocation of fixed overheads to the cost of conversion based on normal capacity. That also we saw in our example. What is normal capacity? Production expected to be achieved. Okay. Actual level of production may be used if it approximates normal capacity. So typically entities take the help of this statement. मैंने जितना बनाया, that is my normal capacity. I wanted to do this much only. See, you cannot dispute that, right? You cannot tell, but you told you will do more. I wanted to do this. So then the absorption will happen based on this basis. There won't be any under or over absorption. You will typically avoid using output method. Always remember this. Output method of absorption typically आप avoid करोगे because in that case absorption rate per unit will be the same. So output method can be used only if you are manufacturing only one product. Only if you are manufacturing only one product. Then output method will work. But if you are having multiple products, output method is not a good representative of your absorption. Okay. When production levels are abnormally low, what will happen when production levels are abnormally low? Underabsorption will be high. Unallocated overheads are recognized as an expense in the period in which they are incurred. That 200 example, in our calculation, we got 200 rupees. So we expensed it out. So when it is abnormally low, you expense it out because you are not able to meet what you had planned. So you are the one who has to take the responsibility for this. In periods of abnormally high production, your normal capacity was 7,500. You have manufactured 15,000 hours. You have utilized 15,000 hours. आपने जितना सोचा उसका डबल आपने बना दिया. Now, does it mean I will absorb on the basis of 15,000? Answer is no. आप नहीं कर सकते ऐसा. See, the cost is 1,500 for 7,500. If your actual cost is 15,000, does it mean you will show 3,000 as the absorption? आप नहीं दिखा सकते. You cannot show 3,000 because you have incurred only 1,500. If you show 3,000, what is happening is your inventory is getting overvalued beyond the cost. Are you able to understand? Your inventory is getting overvalued above the cost, which is not right because your cost hit is only 1,500. So what the standard tells is when you have abnormally high production levels, then you will revise the fixed overheads allocated to each unit of production. So you will now change the absorption rate to 1,500 divided by 15,000, 0.1 per unit. Original what it was, sir, 0.2. Abhi kitna hoga? 0.1. Why did I make 0.1? Because if I had to take 0.2, I would absorb more than the cost incurred. So my inventory would go higher than the cost price, which is not what is right. And therefore you will take the revised absorption rate. Are we okay with this? Yes. Variable production overheads we have discussed. Production overheads must be absorbed on normal capacity. If production capacity is unusual, overheads might be under or over absorbed. Interruptions in production may occur while the costs still get incurred. Are we okay with this on absorption? Yes. Are we okay? Yes. So if there is excess production, you have done well than what you expected. Then revise the absorption rate and apply the new absorption rate towards allocation of your overheads. You can look at these illustrations for your reference. Okay, ये मैं homework के लिए छोड़ देता हूँ. Please look at them. It's exactly what they have explained there. Okay, all right. Now, A business plans for production overheads of 10 lakh per annum. Normal level of production 1 lakh units per annum. Due to supply difficulties, the business was only able to make 75,000 in the current year. Calculate costs per other cost per unit 126. 126. Calculate cost per unit and overheads to be expensed. No other data is given. So यहाँ पे we have to use output method. So other cost 126, overhead absorbed is 10. So that is 10 lakh rupees divided by 1 lakh units. So unit cost is 136. Overheads to be expensed. Total production overheads 10 lakh. You made 75,000 into 10, 7 lakh 50. Under absorbed amount is 2 lakh 50, which I will expense out in the P&L. Are we okay with this? Yes. Are we okay? Any doubts so far? No doubts?
No doubt.
Okay. So then let us process further. Let us proceed further. Okay. Okay. All right, fine. Conversion costs. Another illustration. Manufactures control units for air conditioning systems. Each control unit requires one component X at a cost of 1,205, one component Y at a cost of 800, sundry raw materials at a cost of 150 each. Company incurs the following monthly expenses: 16,500, energy cost 7,500, selling and admin cost 10,000. Each unit takes 2 hours to assemble. Production workers are paid at 300 per hour. Production overheads are absorbed into units of production using an hourly rate. Normal level of production per month is 1,000 hours. Calculate the cost of inventory. Yes, shall we try? It's not very difficult. It's not very difficult. How many of us can get this? I'll give you 2 minutes. Don't look at the study module for the solution, please. If you have understood what I have explained, you should be in a position to get the answer. Even if you make a mistake, it is fine, but please try. I'll give you 3 minutes. It's 8:27 till 8:30. Try. Yes, any answers?
2,803.
Okay, perfect. Yeah. Others? This was who answered? Nisha, Mamta,
Pooja, sir.
Pooja. Okay. All right, fine, great. Others, Karthik, Vignesh, Abrikesh. Yes, Ginny also gave her answer, her or his answer. I am not sure. Okay, so let us quickly run through where did we, you can just have a look. So inventory, you will have one component of X, so 1205, one component of Y, so 800, sundry raw materials 150. So this together comes to 2155. And then I will be having company incurs the following: factory rent, energy cost, selling administrative, 2 hours to assemble, production workers paid at 300. So 300 into 2, labor cost is 600, 2755. And then overhead absorption. So I'm having total overheads 16,500 plus 7,500. 16 plus 7, 23. So that comes to 24,000. 24,000 rupees divided by normal production hours is 1,000. So this comes to rupees 24. And आपने कितने घंटे लिए? 2 hours. So this will be 48. So this is 2,803. Selling and administrative costs, should I consider? Answer is no, because these are not related to bringing the inventory to the current location. This is to make your sale. So they will not be included in the cost of inventory. Are we okay? Did we all get this? Yes?
Yes.
Okay, all right. So that takes care of overheads. Okay. Other costs. Okay. So when we talk about inventories, absorption, okay. All right, fine. Looks to be okay. Something known as, okay, fine. Coming to the next one, you need a break now, or can we take some more time and then give you a break? अभी ब्रेक चाहिए?
Your call, sir.
Okay, so you're okay to go ahead for some more time. Okay, all right. So coming to the next one, joint and byproducts. You would have studied this or heard about this. Joint products are essentially when you are having one process, one manufacturing process, resulting in two products, two or more products. Okay. Byproducts, you may not intend to produce, it gets produced out of the production process. Joint products, you actually intend to produce it jointly. Okay. So the difference between a joint and a byproduct is you actually intend to manufacture joint products, but in the case of a byproduct, you don't intend to, it comes out as an unintentional output. Okay. So what happens in the case of joint products is you will incur certain joint costs. You will incur certain joint costs. I have to apportion. Look at this diagram. I have one process. This is a common process. So I incur something known as joint costs. I have a split off point. At the split off point, I will do some further processing. Some further processing will give me A. Some further processing will give me B. And I don't intend to manufacture, but I have a byproduct C. I have a byproduct C with some net realizable value. This further processing, I incur certain further processing costs. I incur certain further processing costs. Okay. Now, what is the challenge or what is the issue here? See, मैंने बनाए तो A, B and C. I have manufactured 3 items. 2 intended, 1 not intended. But in तीनों का cost comes primarily from a single process. It comes primarily from a single process. And therefore, I have to now allocate. I have to now allocate the joint cost to A, B, and C. How am I going to allocate? Sir, output के हिसाब से कर दो, 3 प्रोडक्ट है, joint cost है, divide joint cost by 3, you will get the total joint cost per unit. You can do that, provided the output is the same. Sir, if output is the same, why will they be different products? Exactly my point. If output is the same, it will not be different products. If they are different products, cost cannot be the same. If they are different products, cost cannot be the same. So output method for allocation of joint cost, never prefer that. Never prefer that unless you have no other option. Unless you have no other option. So output method to gaya. I mean, it is ruled out. Now coming to the next one. A, B and C. C is a byproduct. So for the allocation to C, I have two options. First one is, if I treat the byproduct as something similar to scrap, matlab I don't really intend to make any money out of it. It just came out as an output, which was not really my intention. So when that is the case, then what are you going to do is, you will end up reducing the net realizable value of C from the total joint cost. This is the net realizable value of C. I will reduce it from the total joint cost, and only the net joint cost is what will be apportioned to A and B. C to gaya, C's NRV has been deducted, so nothing will be attributable to C, but the net joint cost I will allocate it to A and B. But on what basis? I will allocate the net joint cost based on sales value at split off point. इसको हम लोग बोलते हैं, we call this as the split off point. At the split off point, the products get split into two products. So if my products are saleable at the split off point, I will allocate the net joint cost, that is this one, on the basis of sales value at split off point. This is the best method of doing. Whose selling price is higher at the split off point, that product is going to get higher cost. Whose selling price is lower, it will get lower cost. So sales value at split off point, provided my joint products are saleable at the split off point. Sir, what if they are not saleable at split off point? If they are not saleable at split off point, then I will allocate based on sale value at completion. I will allocate based on sales value at completion. I will use the second method only if joint products are not saleable at split off point, and they require further processing to become saleable. In the case of byproducts, two rules. First one, if it is not material, if the byproduct is not material, mostly they will be immaterial. Mostly they will not be material. Calculate NRV of byproduct and deduct from joint cost, and then allocate the net joint cost. Something which I just explained to you. If byproduct is material, मतलब आपको लगता है your byproduct is as significant as joint products, then treat it as a joint product and follow 1 and 2 above. What is number 1? Allocate based on sales value at split off point. Number 2, if 1 does not exist, then allocate based on sales value at the point of completion. Are we okay with this? Yes. Are we okay with this? Any doubts? No doubts? Yes. Sure, everyone? Clear? Okay, Abrikesh has confirmed. Mamta, Sumit, Hemant, all clear. Okay, fine. 2 of you have confirmed. Let's proceed. We can look at one question.
Excuse me, sir.
Yes.
Sir, you have explained the third point. Can you please explain it again?
Byproducts.
Yes, sir.
Okay. So, suppose this byproduct is immaterial to you. Okay. Suppose this is immaterial to you. Then you treat it as scrap. स्क्रैप मतलब क्या, आप इसको बनाना ही नहीं चाहते थे, यू डिड नॉट वांट टू मैन्युफैक्चर दिस. नाउ दैट इट इज मैन्युफैक्चर्ड, you will sell it off as scrap. So what
Yes.
you are supposed to do, if it is immaterial to you, if it is immaterial in the overall process, find out the NRV of the byproduct, reduce it from the total joint cost. You will get the net joint cost. This net joint cost I will allocate only to the joint products. Is this okay?
Yes, sir.
Acha. Now you will say, sir, my byproduct is not immaterial. Quantity is good. Output has value in the market. It is significant to me. In
Yes.
that case, I will treat it as a joint product. Have a byproduct, but I will treat it as a joint product. So C becomes a joint product, and I will allocate this cost to A, B, and C. Are we okay?
Yes, sir. Now clear. Thank you, sir.
All clear? Okay. Ginny wanted to ask some question.
Sir, मैं जीनी ही हूँ.
Acha, okay. I didn't see. I'm not able to understand. Okay. Fine. All right. Good. So, theek hai. All right. Anybody
Thank you, sir.
else? No problem. Yes. Okay. So that takes care of joint and byproducts. Anybody has any doubts? Slightly technical, but largely it's okay. All right. So let us come to one question that should resolve most of your issues on joint costs. Question number 8. See, this is basically what I have explained. They put it in a chart. To pad lena. A production process may result in more than one product being produced simultaneously. So joint products, or when there is a main product and a byproduct. Cost of conversion are not separately identifiable. Usko joint cost bolte hai. We call that as the joint cost. They are allocated between the products on a rational and consistent basis. Rational and consistent is not output method. Put that in your mind. Output method is not rational. It is irrational. Okay. The allocation may be based, for example, on the relative sales value either at the stage when the products become separately identifiable. We call this as split off point. At this stage, they are separately identifiable, or at the completion of production, final. Most byproducts are immaterial by nature. They are often measured at NRV, and this is deducted from the cost of the main product. As a result, carrying amount of main product is not materially different from its cost. But if it is material, I told you what needs to be done. Okay. All right. Fine. Okay. When byproduct is material, you treat it as a joint product. That also is explained to you. Okay. So we have covered all these points. So now let us look at illustration 8. We'll do this together. In a manufacturing process of Mars Limited, one byproduct BP emerges besides two main products MP1 and MP2 apart from scrap. Details of cost of production process are as under. Raw material, you are putting in 14,500 units. Amount 1,50,000 for the raw material. Wages, fixed overhead, variable overhead costs are given. Output is 5,000 units of MP1, 4,000 units of MP2, 2,000 units of byproduct. The closing stock is 250 units for MP1 and 100 units for MP2. Average market price is 60 and 50 for MP1 and MP2 respectively. Byproduct is sold at 20 rupees per unit. Profit on sale of byproduct is 5,000 after incurring processing charges of 8,000 and packing charges of 2,000. 5,000 was realized from sale of scrap. Calculate the value of closing stock of MP1 and MP2 as on 31st March 20X1. Okay. How many products are coming out of your process? How many products are coming out of your manufacturing process? One product, two products, three products, four products. Bataiye.
3 products.
3 or 4?
4 total, including scrap.
Yes, including scrap. it is 4. Including scrap, it is 4 products which are coming out. Yes. One is MP1 joint product, MP2 joint product, BP byproduct, scrap 5 scrap. So these are the 4 things which are coming out. Now let us look at the diagrammatic representation. This is the common process. You can copy this for ease of understanding. Okay, this is the common process. For this common process, you are incurring these costs: raw material, labor, fixed overheads, variable overheads. I have only copied these items. Okay, 1,50,000, 90, 65 and 50. So iska total cost is 3,55,000. What is the output? I am getting MP1 5,000 units. I am getting MP2 4,000 units. I am getting byproduct 2,000 units, having a selling price of 20 per unit. I am getting scrap which is sold for 5,000. Are we okay with this? Yes. यहाँ तक ठीक है?
Yes, sir.
This is the question only, but I think by now the question is making better sense. Okay. Byproduct, I am incurring 2 specific costs. Incurring separate processing charges of 8,000, packing charges of 2,000. Okay. So processing charges 8,000, packing charges 2,000. Okay. Tell me one thing. Have they told anything about byproduct? That is, have they mentioned as it is material, it has to be treated as a joint product? Have they told anything, or have they only given the sale value of the byproduct? Question padho, have they given anywhere anything about the byproduct being important, material?
Not clearly directly they are saying, but by way of stating their sale price, we can understand that whether it can be material or immaterial.
My advice is don't go on that basis. It will become judgmental. Okay. It will become judgmental because for you, probably 5,000 sale of byproduct after incurring processing charges, etc. may be material. For Sumit, for example, it may not be material. For Pooja, it may be immaterial. For Mamta, it may be material. You imagine from the perspective of the person evaluating your answer sheets, thousands of people will say it is material, another 2,000 will say it is immaterial. So let us not assume these things in this setup. We will just take it as, if nothing is given, treat it as a byproduct, treat it as immaterial. तो हमको क्या करना है? We have to find out the net realizable value of the byproduct. Net realizable value we will find out, and then we will do the calculation of the net joint cost. Okay. So let us come back
Sir,
to our work.
sir,
Yes.
Sir, in
Go ahead.
very first line of the question, it has been mentioned that in the manufacturing of Mars Limited, one byproduct BP and
Yes.
MP1 apart from scrap. So this
Yes.
will show that a byproduct is also material factors.
Not necessarily. See, when they have given this question, the first line, what is the meaning of that is, you are intending to manufacture MP1 and MP2. A byproduct emerges. मतलब वो आपका intention था ही नहीं बनाने का. That is the intention of this. It in no way points out to the fact that the byproduct is material. ठीक है, scrap comes out, but scrap cannot be equated to a byproduct. Okay, scrap comes out of any and every manufacturing process. Okay, तो scrap के बारे में तो you always have to treat it as immaterial.
Yes, yes.
The byproduct which is coming out, they have not mentioned anything. This is just pointing out to the fact that these are the 3 categories of products we are having right now. Okay.
Okay.
ठीक है. So now, what is the sales value of your byproduct? I have 2,000 units and Average market one of MP1, MP2 byproduct is sold at 20 rupees per unit. So 2000 at 20, 40,000. Okay. Processing charges 8,000. Packing charges 2,000. So your net realizable value is 30,000. This is how you calculate net realizable value. Final selling price minus cost incurred to complete the sale. Minus cost incurred to complete the sale. So 40,000 minus 10,000, 30,000 is your NRV of the byproduct. So now let us calculate the net joint cost. What is your net joint cost? Total joint cost is 3,55,000. NRV of byproduct 30. Sale of scrap 5,000. Is it given in the question? Yes, 5,000 was realized from sale of scrap. So 3,55,000 minus 35. Net joint cost is 3,20,000. Are we okay with this so far? Yes. So I have given the same treatment to the byproduct as that of scrap. I have calculated the NRV and deducted it from total joint cost to arrive at net joint cost. Ginny, is it okay? Yes. Sumit, Mamta, Pooja, सब ठीक है? Nisha, Vignesh, all
Sir,
clear?
The profit of 5,000 on sale of byproduct, what do we have to do with this 5,000?
Profit of 5,000 you ignore because what we have to deduct is the net realizable value. We are not concerned with what is the profit I am making on the sale of the byproduct. That sentence does not carry any relevance. Okay. ठीक है. Hemant, you have a doubt?
excuse me, sir.
Yes.
Sir, we have calculated the NRV of byproduct. Then how we can decide whether the byproduct is material or not?
See, unfortunately, this is who is this?
Genie.
Acha, unfortunately, Ginny, the standard does not prescribe guidelines for materiality. Okay. That is a judgment call that needs to be taken. So my advice, until the question specifically tells you the byproduct is material, you have to treat it. It's advised to treat it as immaterial. Treat it as something for which you calculate the NRV and close it. Okay.
Okay,
Don't
sir.
go for taking it as material, because if you take it as material, it becomes a joint product. And when it becomes a joint product, तो उसको by product क्यों बोलोगे? है ना?
Yes, sir, that's why I asked.
So that's why you take it as material. Okay. Okay. Hemant, yes, NRV has a profit component. Okay. NRV has a profit component. We are not concerned with that. Okay. We are not concerned with that. Okay. NRV will have the markup that you are concerned, that you are considering. Okay. Only when your NRV goes lower than your cost, it will not have a profit component. Okay. That depends. NRV is more of a price attributable to the entity from a market perspective. It's not exactly a fair value. It's more of a market related metric that we are computing from the entity's perspective. That is what is your NRV. I'll come to NRV shortly. Okay. Because that is the last point of it. Okay. All right. Now, calculation of net joint cost. Now, what we need to do is we need to allocate the net joint cost of 3,20,000 to the two joint products, MP1 and MP2. So MP1, 5,000 units I have manufactured. MP2, 4,000. Selling price is 60 and 50 respectively. So ठीक है, 5,000 into 60 is 3 lakhs. 4,000 into 50 is 2 lakhs. I will allocate 3,20,000 in the ratio of 3:2. That is 1,92,000 and 1,28,000. So your joint cost per unit, 1,92,000 divided by 5,000, 38.4. Are we okay with this? Yes. If you are writing, I will wait. Otherwise, any case, I'm going to share this this manual working sheet with all of you. Okay. This I'm anyways going to share. Okay. All right. So 38.4 per unit for MP1, 32 per unit for MP2. Okay. All clear? So this is your allocation of joint cost. Okay, let me know if I can proceed further. Hemant, I hope you understood your answer to your query. Yes. All right, fine. Great. Vignesh, hope it's all clear. Usha, Joshi, Hemant, Mamta. All right. Okay. Looks fine to me. Okay, so let's proceed further. We'll proceed further. So valuation of closing stock. I have 250 units of MP1 and 100 units of MP2. So 250 into 38.4, 9,600. 100 into 32, 3,200. That's it. So that's all that is asked in the question. That's all which is asked in the question. Okay. So calculate value of closing stock कर दिया हमने. Yes. All right. Perfect. So illustration 8 is done. Okay. So now coming back to our discussion. Conversion cost हो गया, joint cost हो गया. We shall now come to other costs. Other costs are, what does other cost mean? See, we discussed purchase price, we discussed conversion costs, then we discussed cost of inventories includes purchase, duties, transport handling, other cost of conversion. So finally, we have other costs only to the extent incurred in bringing inventories to their present location and condition. Nothing apart from this. What am I going to exclude from the cost of inventories and recognize as expenses? Abnormal amounts of wasted materials, labor or other production costs exclude. Storage costs you exclude unless they are necessary in the production process before a further production stage. Typically in your wine and liquor manufacturing entities, the aging is critical to the quality of the product. The aging of the underlying item, whether it is fermented rice or grapes or whatever it is, the aging of that is critical. And therefore, the production of liquor or whiskey involves storing the liquor, the distilled item in a cask for a long period of time. So there you will include the storage costs in the product cost. Otherwise, storage cost will not be included. Abnormal amounts of wastage will not be included. Administrative overheads that do not contribute to bringing overheads to present location and conditions will not be included. Selling costs will not be included. So these are the items that are going to be excluded. Okay. The extent to which borrowing cost is included will be determined under Ind AS 23 borrowing costs. Okay. Okay. So that you can study in Ind AS 23. Okay. Okay. Sometimes inventories are acquired on deferred settlement terms. Deferred settlement terms means what? I will buy now and pay over an extended period of time. Pay over an extended period of time. When the arrangement contains a financing element, then you will recognize that financing element as an interest cost and expense it in the P&L. It will not form part of inventory cost. For example, a dealer has purchased 1,000 costing 2,80,000 each on deferred payment basis at 25,000 per month. So cash price is 2,80,000. How much are you paying? 25,000 into 12, 3 lakhs. So therefore, per car, 20,000 is your interest cost, financing cost. This will not go in the cost of inventory because you are deferring the payment terms. It is something like opposite of cash discount, which we saw. Cash discount, I pay within the credit period, I get a discount. Here, I extend my payment because of whatever issue. So therefore, I will have to pay a higher amount, and that is why it will be treated as a finance cost. At the year end, 20 cars are in stock. So cost of inventory will be 20 into 2,80,000. 1,000 cars are purchased. So finance cost for 1,000 into 20,000, 2 crores. Cost of goods sold, 100 purchased, 20 in stock. So 980 into 2,80,000, 27.44 crores. Fairly simple. Okay. So that's all that we have on other costs. Okay. So this chart you can go through. All right. It's absolutely easy. This illustration 6, you need to identify what is going to go in inventory under Ind AS 2 Karlena. Okay, do that. Selling costs are excluded. Distribution cost, would you include? Answer is no. Distribution, selling are all part of the same. Sirf naam ka farak hai. So this also go through as homework. These are not going to form part of your examinations anywhere. Okay. So are we clear till now? Are we clear till now? Yes.
Yes.
Okay. So coming to, you need a break or shall I continue? If we continue, I will try to leave you by 9:30, 9:45. If we take a break, I will have to take till at least almost 10 a.m.
Continue, sir.
अच्छा, कंटिन्यू कर दें, सबको जल्दी छूटना है. ठीक है. All right, fine. So net realizable value, simple definition, expected selling price or contracted price in case of firm order minus cost of sale or completion, cost of expected cost of making the sale or expected cost of completion. So that gives you the net realizable value. Have you studied Ind AS 113 relating to fair value measurement? Have you gone through Ind AS 113 fair value? Not yet. Okay, fine. See, when you do fair value, there also you will come across something related to market price. And when you look at NRV, you are looking at something related to selling price. So the immediate conclusion that probably you will end up drawing is NRV is fair value. It's not the case. It's not the case. Okay. When I talk about fair value, this is Ind AS 113. What fair value tells? It reflects the price at which an orderly transaction to sell the same inventory in the principal or most advantageous market between market participants at the measurement date. So that means what? My fair value is a market-based measurement. It talks about the value of your product or inventory or asset or bond or whatever it is that you are having, because we are having a standard regime that has lot of references to fair value. So when I talk about fair value, it is primarily going to be from the perspective of a market participant. But NRV jo hai, this NRV, what you are seeing is basically my selling price minus my cost to incur to complete the product and make it saleable. So net realizable value is an entity specific value. Fair value is a market based value. Net realizable value is exclusive to me. What is my NRV cannot be somebody else's NRV. But what is my fair value can be somebody else's fair value, because that is a market-based measurement. That is a market-based scenario. Okay? So that is the only point I wanted to highlight. That's why I brought you back here. That fair value, you cannot say that NRV equals to fair value. They are two different concepts altogether. Okay? All right. NRV is the net amount that an entity expects to realize from sale of inventory in the ordinary course of business. Okay. All right. Fine. So that is done. So net realizable value we have seen. Okay. And the final rule, something that you have been studying right from day one, inventory should be valued at lower of cost or net realizable value. Okay. So now let us move further on this. We'll discuss a couple of things. Okay. All right. Okay. What about agricultural produce harvested from biological assets? You remember I had told you scope exclusions, complete exclusions, agricultural produce at the point of harvest. Partial exclusion, agricultural produce after harvest. This is talking about harvested. Harvested means what? After harvest. After harvest. Is it covered under inventory? Presentation disclosure, yes. Measurement, no. Measurement goes under Ind AS 2. तो उसका थोड़ा सा राइट अप दिया है. Inventories comprising agricultural produce that an entity has harvested are measured on initial recognition at fair value less cost to sell at the point of harvest. At the point of harvest, what is the fair value less cost to sell? That becomes your cost for the purpose. This is the cost for application of this standard. The fair value less cost to sell, you find out as per Ind AS 41. That becomes the cost for the application of Ind AS 2. Okay, so that is your cost of agricultural produce. Techniques for the measurement of cost, such as, okay, so that takes care. Now coming to certain techniques for cost measurement. Okay, these are all very simple. Okay, fine. Now, when we talk about inventory valuation techniques, let us look at this chart. हम chart देखेंगे, then we will understand the theory, because charts will stay fixed in your mind. If I run you through the theory, it becomes difficult. So inventories can be broadly categorized into two types. The first one is inventory ordinarily interchangeable. What do you mean by this? If I manufacture something, Mamta can also purchase, Abrikesh can also purchase, Jeannie can also purchase, Pooja can purchase, Niranjan can purchase, anybody can purchase. Today's Mamta will come and tell, I will need 10 packets of detergent from you. Suppose she does not come. Instead, Abdikesh will come and say, sir, I need 10 packets. What 10 packets? I'll give it to him. He will buy and pay me the amount and go. So these are cases of inventories ordinarily interchangeable. In some cases, your inventories may be not ordinarily interchangeable. Customized inventory जिसको बोलते हैं. Customized inventories. Okay. Suppose Jeannie comes to me and says that she wants a vehicle that is having certain particular specifications. Okay. So I will manufacture that vehicle tailored to her requirements. I will manufacture that vehicle tailored to her specific requirements. Now, those requirements are not acceptable to anybody else in the market. It's her requirement. So it becomes an inventory which is identifiable to a particular customer. We call it as inventory, not ordinarily interchangeable. So when I have to value the inventory that I am manufacturing for a specific customer, I cannot follow regular FIFO, LIFO, historical cost, etc. ये inventory has a special purpose for a special customer made in a special manner. And therefore, I will be using the specific identification method. Generally, we use it in jewelry and tailor-made industries. Okay. So if one of you goes to a jewelry store and you want a particular item of jewelry in a particular fashion, in a particular style, then that is identifiable only to you. So the cost of that inventory will be the specific cost for that piece which is made for you. ठीक है, उसमें FIFO, LIFO, historical cost, all of that is not going to come. Okay, coming to inventory ordinarily interchangeable, the first example that I gave, detergent ka, anybody can take it. Now, this again we split into historical cost method and non-historical cost method. Historical and non-historical cost methods. तो historical cost method में क्या आता है? What you already know, FIFO and weighted average. Historical cost. Inventory I bought, I'm going to do the sale. Whatever is there in my stock, I will value it on FIFO basis or weighted average basis, as the case may be. What about non-historical methods? Well, non-historical methods, specifically two types are there. One is retail inventory or standard cost method. What is retail inventory or adjusted selling price method? How many of you have been to Reliance Smart Bazaar or Big Bazaar or whatever? So many grocery shops are there, right? How many of you have been there? Yes, a huge departmental store, whatever be the name in your city. Yes. Okay, so you have all been there. So usme, if I look at shampoos, I'll have 100 varieties of shampoos. If I look at detergent, I will have 100 varieties of detergents. If I look at toothpaste, I will have 50 varieties of toothpastes. If I look at rice only, I will have 25 items of 25 categories of rice. Steamed rice, basmati rice, Sona Masuri rice, grade A, grade B, grade C, colored rice, polished, unpolished, XYZ, all these things are there. So if I have to maintain the historical cost of each of these items, and I have to apply either FIFO or weighted average, don't you think it will be cumbersome? Just imagine an entity like Reliance Smart Bazaar that will have lakhs of inventory items. What will be the time that will be consumed? Of course, this will be system driven. Of course, these will be system driven. But nonetheless, I need to maintain the inventory in that particular manner for it to be system driven. Yes or no? Today, I buy rice of say 300 kgs in Reliance Smart Bazaar. Tomorrow, I will buy another 500 kgs. Day after tomorrow, I buy 250 kgs. If I have to apply FIFO, all these bags have to be maintained separately. If I have to find detergents, I have to maintain them separately. If I have to take the toothpaste, I have to maintain them separately. It is a huge drain on the resources. It is a huge drain on the resources. So what the standard gives is an exception here. The standard tells you can follow the retail inventory or adjusted selling price method. What does that method tell? It tells that cost is nothing but selling price minus gross margin. So each item, you know the selling price? Yes. Is it punched in the system? Yes. हर आइटम का ग्रॉस मार्जिन पता है आपको? Yes. Do you know the gross margin or material margin of each product? Answer is yes. So selling price minus margin will be the cost of that inventory. Take that cost and do the valuation. Don't go for FIFO, weighted average, historical cost, etc., because your inventories are rapidly moving. In Reliance Smart Bazaar, today I buy 500 kgs of rice. It is possible that today only it gets over. Tomorrow I have to again buy. So therefore, it does not make sense to maintain a detailed record and do the workings. You can follow adjusted selling price mechanism. Are we okay with this? Yes. It is followed when large numbers of rapidly changing items with similar margins are involved. So typically your best example becomes your grocery store. Your best example becomes your grocery stores. Okay. The other one is your standard cost method. It takes into accounts normal levels and is reviewed regularly. Normal levels of material supply, labor efficiency, capacity utilization. So take for example, so your retail inventory selling price method, this will be your grocery store. Grocery departmental store. And standard cost method, your products are of the same type. आप एक ही तरह का प्रोडक्ट बनाते हो. कहां पे दिखता है ये? असेंबली लाइंस. Cars are manufactured. Yes. Now, when you are manufacturing cars, each car is a standard type, right? If you are manufacturing a Swift Desire, then a Swift Desire of a particular variant X will be the same even if it is manufactured after 6 months. There won't be any change in that vehicle. So therefore, there we can use a standard cost method. So what does it do? Takes into account normal levels of material, supplies, labor efficiency, capacity utilization. You arrive at the standard cost. That standard cost will be the cost of that inventory. You don't have to remeasure the inventory cost again and again. But you will monitor the standard cost regularly. If there is a variation in the actual cost of a significant level, like for example, there is a stock shortage and you have to procure the product, the spares from outside India, it will lead to a rise in the cost. When that is the situation, you will monitor it, take the increased cost, that will become your revised standard, and then apply that revised standard after the period when the prices have escalated. Are we okay with this? Yes. Are we okay? Any doubts? Yes. So inventory valuation techniques depends on two categories. What is the nature of your inventory? If it is specifically identifiable, then the cost for that inventory is what you will consider. If it is ordinary interchangeable, historical method, non-historical. Historical may you have FIFO and weighted average. LIFO is not acceptable under Ind AS 2. If it is non-historical cost, you can follow the adjusted retail selling price margin method, or you can follow the other one, that is the standard cost method. Yes, all clear? Pooja, sab theek hai? Jeannie, all clear? Yes, she has confirmed. Yes.
Yes, sir.
All right. Mamta, all well? Karthik has not reverted.
Yes, sir.
Nisha, all clear? Vignesh? Yeah, Brikesh, tell me.
Sir, you told that LIFO is not allowed in Ind AS 2.
Yes.
So in question, if the valuation has been asked on LIFO method, suppose just to check our knowledge, then what we should write?
See, it won't come, number one. Even if it comes, you will have to specifically mention that LIFO is not permitted under Ind AS 2. Okay. It won't come. I think we can fairly trust that it will never come. If it comes, please mention that LIFO is not an acceptable valuation method. And for further clarity, if you have the time and you want to present your answer, you give the valuation under FIFO or weighted average and tell it can be either of these two, but LIFO, so certainly it cannot. Okay. All right.
Okay.
Fine. Yes. All right. So I have explained inventory not ordinarily interchangeable, inventory ordinarily interchangeable. These are the, so FIFO and weighted average, we call them as cost formula. So FIFO method, I hope I don't need to get into the details. FIFO is first in, first out. So the latest material which has come in is what will form part of your closing stock. Weighted average cost formula, it averages out the cost on a moving average basis. So therefore, your product price will remain on a weighted average basis. Why weighted? Because it will be total of the cost divided by total of the quantities. So that is your calculation. Okay, so formula. Last in, first out, as the name suggests, opposite of FIFO. It is not an acceptable cost formula under Ind AS 2. It's given in bold, so you can remember that. Okay, all right. Okay. Fine. So now you can go through this. Do you need my help for doing FIFO and weighted average, or can you manage by yourself? Yes. Manageable, everyone. I need everyone's consent on this.
Manageable, sir.
Manageable, yes, because it's quite elementary. So Nisha, yeah,
Manageable, sir.
manageable. Okay, fine. Pooja, sab aap kar sakoge? Yes. All right. Good. Great. So I'm happy. So this one question I leave you for homework. Very simple question. Okay. FIFO का करना है, weighted average का करना है. This particular, my humble opinion, this particular points which I have highlighted, please don't take that into consideration. This is the right answer. Okay. This is the right answer. Okay. Please take this. I'll do one thing. I'll just show you the workings for this illustration. One. Where is it? Just check. It must be in an earlier batch. Yeah, so this is example 4. You can just take a screenshot of this. Okay, 427. Closing inventory. Okay, 125, 2.82, 352.5. COGS is equal to 157.5 plus 270. So 4.5. Okay. Yes. So you can just take a screenshot of this. You can try it out by yourself. This is weighted average method. Okay. Where opening is known, quantity, amount, average. Okay. So average is the balancing figure. Quantity, amount you take, add both of them, divide the amount by the quantity to arrive at the average. So that takes care of this one. Okay. So please take care of this one question. Okay. All right. Now the question is, the standard tells an entity shall use the same cost formula for all inventories having a similar nature and use to the entity. For inventories with a different nature or use, different cost formulae may be justified. So if I look at an entity like Reliance Retail, for example, okay, Reliance Retail could be having some items on FIFO, some items on weighted average. Is it acceptable? Depending on the categories, yes, it is acceptable. But suppose the same category across different geographical locations, is it acceptable? Answer is no, it is not acceptable. State whether an entity can use different cost formulae for inventories held at different locations. Answer is no, not permitted. Okay, absolutely not permitted. Different categories, different cost formula. Same category, only one cost formula. You cannot go into multiple cost formula. Is it okay? Yes. All right. Fine. So here you have certain measurement techniques of cost. So here the first one is Mars Fashions. You can use the retail margin because there is an average gross margin of 65%. So this is gross margin method. And Mass Fashions also sells handbags. Standard cost is there, uses 15% of space, overheads, which goes, they are manufactured for the last 50 years. All right, seeing as an efficient division. So you can follow the standard cost method here. Standard cost method. Okay. Just pad lena, there is no numbers involved in this. So you can go through that. Okay. So that is done. This is done. Next one is all right. So okay. Okay. Now coming to illustration 11. Okay. Mercury Limited uses a periodic inventory system. The following information relates to X1, X2. April, May, September, February, you are having opening inventory purchases. So total 1000 units you have purchased, 12,250 rupees is the cost. Physical inventory at 31st March X2 is 400 units. Calculate ending inventory value and cost of sales. Using FIFO. FIFO के case में it is simple, 400 units. So it will be out of this lot 350 and 50 will be out of this lot. So 350 into 14 plus 50 into 12, 600. 350 into 14, 4,900, right? Yes, so 5,500. Now, you have sold the inventory. You have sold the inventory. So the cost will be 12,250 minus 5,500. Are we okay with this? Yes?
Yes.
Simple. COGS is equal to 12,250 minus 5,500, 6,750. Is it okay? Everyone? Have you understood this part? FIFO? Yes. All right. Jeannie has confirmed. Okay. Karthik, did you understand? Okay. Coming to weighted average. Weighted average, I am not very comfortable with this answer. I'll tell you why. See, weighted average should be a moving average. I can say that there is lack of data in the question. That is why Institute has given this method. But what is happening is the detail of sales during the period is not given. If you know how weighted average moves, it will be inwards, then some inwards, then an outward, then an inward. So each and every time there is an outward, it will be measured on the weighted average price at that point of time. Here what is happening is they have not given sales data during the entire year. ठीक है, आप देख सकते हो April, May, September, February, you are having opening inventory, purchase. Are you given sales data? You are not given sales data. If I look at the weighted average cost, 12,250 divided by 1,000, 12.25. This is okay because no other data is available. But this is okay only if nothing is sold during the period. But bika hai na, something is sold. When you have 400 units only in the closing stock, you have 1,000 units. That means 600 units would have been sold. If 400 is in the stock, 600 would have been sold. Yes or no? And therefore, what they have done is they have taken the total average price 12.25 into 400. I have an issue here. Okay. Nothing serious because data ही नहीं है question में. But data होना चाहिए था is what is my humble submission. Okay, I hope you are able to understand my point. I hope you are able to understand my issue. Yeah. यहाँ पे क्या हो रहा है? The COGS is coming only on 31st March 20x2. How can that happen? Yes, the COGS is coming only on 31st March x2 because at that point of time all purchases are done. But ऐसा तो नहीं होता ना, sale has happened before, then you apply. तो ऐसा नहीं होता है. So in the absence of the data, this is the best way the solution can be presented. So on that front, I'm okay. Absence of data, if this is the answer, you can go ahead with this. But more data points had to be given. Okay. So cost of sales, okay, if nothing is given, you will have to do it this way. Okay. So I rest my question at this point, my commentary on this. Okay. But otherwise, it's okay. The FIFO part is absolutely correct. There is no doubt on that. Okay. All right. Coming to net realizable value. Yeah, some more discussions. NRV, whether the following cost should be considered while determining the NRV of the inventories. Cost of completing work in progress, yes, you will deduct it because it is sale value minus cost of making the sale. So selling price minus cost of making the sale will be your NRV. So cost of completion of work in progress also will come in that. Trade discounts expected to be allowed on sale. So trade discount also will be considered from the selling price reduction because it is related to you. So that also you will consider. Cash discount has no bearing to your selling price. You will not consider this. So that is about net realizable value. Okay. All right. Fine. Go through these details. Okay. This is going to give you certain clarity. Okay. Certain additional insights. Okay. Typically your NRV at the reporting period is what is to be considered. Sometimes you may get certain evidence of certain events after the balance sheet date, which point out to the fact that NRV would have reduced as at the reporting date. We can look at this question. ABC manufactures and sells paper envelopes. The stock was included in the closing inventory at a cost of 50 rupees per pack. During final audit, the auditors noted that the subsequent selling price was 40 per pack on 15th April 20x1. As on 31st March, cost was 50. In 15 days, the selling price became 40. Why did this happen? Furthermore, inquiry reveals that during physical stock take, a water leakage has created damages to the paper and the glue. And accordingly, in the following week, ABC has spent a total of 15 per pack for repairing and reapplying glue to the envelopes. Calculate the net realizable value and inventory write-down amount. So, very simple. Is there an event that existed at the balance sheet date? Yes, that water leak was there. Now, because of that water leak, did it reduce my NRV? Answer is yes. So will this be an adjusting event? Answer is yes. You will have to take it as an adjusting event and do the inventory write down in the year ended 31st March 20x1. NRV is 40 rupees final selling price minus cost incurred to bring it to the saleable condition, that is 15. That comes to 25 per pack. So cost was 50, NRV is 25. So write down will be rupees 25 per pack. Are we okay with this? Yes. Are we okay? Yes. Any doubts? No doubts? Events occurring after the balance sheet date. This is giving me an evidence of the fact that an event has happened which is affecting my valuation at the reporting date because of conditions which existed at the reporting date. Okay? So on this basis, let us move further. All right. So you have to measure your inventory at cost or NRV, whichever is less. But suppose in the future, your NRV increases because of improvement in conditions, because of improvement in market prices. Then can I reverse the write-off? Answer is yes. You can reverse the write-down. You will always have to maintain at cost or NRV, whichever is lower. If NRV increases, you will increase it until you reach the cost price. Cost ke upar nahi ja sakta. Yes. So you can do a reversal of the write down also in the future. Okay. So we don't call it as a write back or write up. What we mention is a reversal of the write down. So it will be limited to that write down which you had done earlier. Okay. All right. So at the end of its financial year, company P has 100 units of inventory recorded at a carrying amount of 10 per unit. Market price is 8 per unit at which these units can be sold. P has a firm sales contract with Q to sell 60 units at 11 per unit, which cannot be settled net. Estimated incremental selling cost is 1. So when you are performing the NRV, I have 100 units. 100 units can be classified into firm order and others. Firm order, I have 60 units. So here I will have 40 units. So for 60 units, it is 11 minus 1 incremental selling cost. So this is equal to 10. 40 units, it will be current market price 8 minus 1, 7. So total cost of the inventory will be 60 into 10, 600, 40 into 7, 280, 880. Are we okay with this? Yes. Are we okay? Yes. Simple enough. 600, 280, 880. Yes. Compute net realizable value. All right. Now, inventories are usually written down to NRV item by item. It is not appropriate to write down inventories on the basis of classification of inventory. Like for example, all FGs or all inventories in a particular segment, I will follow one rule. I cannot do that. The cost and net realizable value to be compared for each identifiable item of inventory or group of similar inventories rather than for inventory in total. Okay. So you have 8,000. Very simple. Account of inventory gives you cost, estimated selling price, and selling cost. So estimated selling price minus selling cost gives you the NRV. So this is 7,300, 17,800, 16,800, 7,350. So what you have to do is line by line, I will compare cost and net realizable value. Line by line, I will compare cost and net realizable value. Whatever is high or lower, that will be the valuation of inventory. So 7,300, 14,000, 16,000, 6,000. So 14, 16, 30, 36 plus 7, 43,300. Fairly simple. Isme nothing to add. Writing inventories down to NRV, we have discussed. Yes. All right. So what is important is the write down should be done of the inventories. A reduction in profit in the future is not going to be the basis for write down. You are able to meet the cost. Your selling price has come down, but there will be a profit margin. If that is the case, you cannot say that do an NRV write down because you are recovering the cost for sure. Okay. All right, fine. So that is done. Okay. No, next one. Reversal of write down. I have explained to you. Yes, that's it. Nothing else. This one you can do for homework. On a group basis, again, I am not sure why this is given. Just now they said on a group basis we cannot consider. Okay. So this ideally should not come. Just on an item by item basis, you should be able to give the inventory valuation. So that's okay. Coming to this question, illustration 16. Opening inventory of FG is given, raw material is given, purchase, labor, fixed overheads, sales is given, closing stock of raw materials and finished goods. Expected production was 15,000 kg of finished product. Due to fall in market demand, the sale price was 20 per kg. Replacement cost for raw material was 9.5 per kg on the closing day. Calculate the closing inventory as on that date. Okay. So now let us come to the last point of our discussion. Okay. So one thing is, let us take this data. Opening inventory, we are having purchases 1 lakh. One second. Stock of finished. All right. This 10,200 is nothing but opening stock of raw materials 1,100 plus purchase of raw materials. They should have given it more clarity. Plus 10,000 minus 900. So that comes to 10,200, and you have purchased it at 10,200 at 10 rupees per kg. That's right. Yes. So 1 lakh divided by 10,000. So 10 rupees per kg. So 10,200 into 10, 1 lakh 2,000. Direct labor 76,500. Coming to fixed overheads, 75,000. Expected production was 15,000 kg. Hours data is not given. Labor hours, machine hours, that data is not given. So I have to take the output method. 75,000 divided by 15,000 into 10,200. So that comes to 51,000. So cost of production comes to 2,29,500. So 2,29,500 divided by 10,200. So this comes to 22.5 cost per unit. Expect the market demand for finished goods was 20 per kg. So net realizable value 20 per kg. Are we okay with this? Yes. Are we okay? Yeah. Others?
Yes, sir.
All right. सब कोई ठीक है. Okay. Fine. Looks to be okay. Nisha, Sumit, Vignesh, all well? Okay. Fine. So you will value this at 20. Now there is one interesting thing here. See, ideally, do you sell your raw materials? Answer is no. I use them for manufacturing. So therefore, raw material NRV nobody finds out. Why? Because I don't sell a raw material. I use it for my manufacturing. So when you use it for your manufacturing, the question of selling it does not arise. But there is an exception to this. In case my final product, my finished goods, I am having NRV lower than the cost. For my finished goods, I am having NRV lower than the cost. Here my cost is 22.5, NRV is 20. So this is triggered. I will have a write down of my finished goods. Yes, I will have a write down of my finished goods. So 1,200 is your finished goods quantity into 20. So this comes to 24,000. If I have a write down of my finished goods, then I have to check my raw material also. Raw material I have purchased at 10 rupees. Raw materials I have purchased at 10 rupees. Raw material NRV ढूंढना पड़ेगा. But the standard gives a relaxation. if you are unable to find the NRV, which will be most of the cases because raw materials we don't sell. तो उसका price अपने को नहीं होगा. We will not have the selling price of that. So therefore, if you cannot find the NRV, you can take the replacement cost. You can take the replacement cost for that raw material. So as on this date, it was 9.5. So cost of raw material was 10. Replacement cost is 9.5. So lower of the two is 9.5. So your closing stock is 900 into 9.5, 8,550. So therefore 32,550 is going to be the valuation of your closing inventory. Your raw materials will be written down to replacement cost or NRV only if the finished product in which they are going to be consumed has an NRV which is lower than cost. Has an NRV which is lower than cost. Are we okay with this? Yes, sure. ये बात समझ में आ गई raw materials की. You will look at raw materials only when the finished product in which they are consumed has an NRV write down. नहीं तो आप write down नहीं करोगे. You will not do a write down for raw materials, even though the raw materials NRV is lower than raw material cost. That is important. Suppose standalone basis पे raw material prices have suddenly crashed, but your finished product has a high selling price than the cost. You are able to meet your cost and make profit also. Even in that case, raw material prices have crashed, finished goods prices are still above cost, then don't do a write down of raw materials. Raw material will continue to appear at cost. Are we okay with this? Yes, are we okay with this? Anybody has any doubts? Yes, okay. All right, fine. So, coming to the last couple of minutes, amount of inventories recognized as an expense, it will be the cost of goods sold. Write down and write off also is going to be something which is appearing in your profit and loss. Reversal of write down also will come. In some cases, the inventory costs will be going into your assets if they are used for construction of assets. For example, a real estate developer builds his own office. Then the inventory cost will go towards the asset capitalization also. What are you going to disclose? What is the accounting policies, including the cost formula used? Analysis of carrying amount. You will have basically all these categorization of inventories. Inventories carried at fair value less cost to sell, agricultural produce, those categories. Amounts recognized in profit and loss, and inventories pledged as security for liabilities. These are the 5 disclosures. That's about it. Okay. So we are done with our standard on inventories. Yes. My advice, go through these questions for homework. I have done question 4 for you. Yes. I want you to try question number. I'm not interested in 1 and 2 more. I am more interested in question number 6. For me, you try question number 6. I think we are meeting again on 2nd of November, right? For Ind AS 20, that is government grants. Okay? Us time pe, if you are having any doubts in question number 6, please feel free to reach out to me. Okay? But as of now, yeah, the standard is done. We have covered all the topics. Yes. That's it from my side. Thank you. You have been quite engaging. Thanks, Jeannie, for your feedback. Yes, thank you very much. So see you guys on 2nd November. Have a blessed Diwali. Yes, see you after the festival. Okay. All right then. Thanks from our side. Okay. All right. Thank you, Mamta. Thanks, everyone. Thank you. Thanks, Nisha.
Sir, Abrakesh.
Abrakesh, tell me.
Sir, as per schedule, there will be class on 11th November after 30th.
As per the schedule?
After 30th October, There will be it's directly on 11th November. Financial reporting, that is also chapter 13 and not by you, sir. So it's on one it is there because it's not mentioned in schedule.
नहीं, the schedule will come out. I have received the first cut of the schedule. So I think we will be having a session. I know that the schedule has not yet come. It's not yet visible, but yeah, I was looking at the schedule, paper 1 financial reporting.
Sir, the timing is
11th,
also different.
I
2 to
think there is a jumble that has happened for the timing because I cannot. This is normally your foundation timing, 2 to 4 p.m. Okay, and the chapter unit 1 statistical description of data. I think we don't have any such chapter for financial reporting, right?
Yes, sir.
But
It is
statistical
only updated there.
yes. So my understanding, this could probably be a foundation schedule which has, peeped into final. Okay. So I think it will be rectified. We are meeting on 2nd November. At least that much I'm aware of. Okay. The schedule should come up by today or tomorrow. Okay. Yeah. So that's about it from my side. See you then on 2nd November. Okay. All
Happy
right.
Diwali, sir.
Happy Diwali. Bye bye. Take care. Yeah, that's it.
Happy
Thanks,
Diwali.
Manish.
Yeah. See you.
Ashok ji, thank you. Happy Diwali.
Thank you,
Sir,
sir.
happy Diwali.
Thank you, everyone. Sir, happy Diwali, सबको. Yes. All right. Thanks.
Sir, same to you.
Yes. आप सेशन एंड कर सकते हो. Yes. Thank you, sir. आपको भी हैप्पी दिवाली. Thank you. Thank you.